Ladies and gentlemen, this is your captain speaking. Welcome aboard Captain Fi, the Financial Independence Podcast. G'day! Welcome to an episode of Captain Fi, the Financial Independence Podcast, where I open the cockpit to some of the best and brightest in personal finance, as well as those who've reached or are on their way to financial independence. Before we get started today, remember anything on the show is provided for general information only and should not be taken as constituting professional advice. You should always do your own research when making any financial decision. G'day everyone, Captain Fi here. Checking in with episode number 2, my financial independence investment strategy. So after releasing number 1, had a lot of questions from the listeners and the viewers asking to speak a little bit more about my personal circumstance, my journey towards FIRE, and specifically my investment strategy. So first of all, as we spoke about on the last episode, it's super important that in your pursuit of financial independence that you're going to set yourself some goals, educate yourself, decide on an investment strategy, and that's really going to help you stay accountable to your goals. So remember, smart investors educate themselves, regularly read, and set about to investing regularly. So for me personally, I'm the kind of person I really need to understand why. I guess my background is I trained professionally as an engineer, aerospace engineer, and I actually really love the industry and I hope to one day continue to work in the aerospace or the space sector. So for a lot of engineers, they got to understand why. Why am I doing something? Why does this machine operate? Why does this system operate the way it does? And once they understand, it's like a light bulb moment, the penny drops, and then they're happy to work on that system or keep improving that system. And, I'm the same with flying. I really have to understand how an aircraft works and how a system works. And thankfully, having a bit of a technical background in aerospace engineering, that really helps me. So when it comes to investing, I really need to know the why of FI. So my goal to reaching financial independence for some time has really been with the idea of starting a family. I want to get to a point where I've got enough passive income coming in where, I can afford to buy my own block of land in the country and I can raise my kids. So you do some reading and there's a Trinity study which led to a pretty widely accepted agreement within the FI community of 4% being a safe drawdown rate. So based on my projected spending in retirement, and the 4% rule, I would really need to buy and hold a portfolio of around $600,000 of ETFs just for myself, and that's based off a spending of around $24,000 per year, and increasing up to the $1 million mark with family. So you can imagine raising some kids might be a little bit more expensive, and so I'm budging a projected spend increase of up to $40,000 per year. So there's a rough number to start with. Okay, why I want to be financially independent. I don't want to be locked down to, a flying roster where I don't know what I'm doing in advance and I'm away from my family quite frequently. So yeah, I want to get financial independence and I want to be able to have more control over where my time goes. So based on the 4% rule, looking at somewhere between $600,000 to $1 million worth of investments. So the second thing when I'm setting my goal here is I've got to realise that as an Australian, we have a fairly unique tax retirement structure called superannuation or super, which means that Australians pretty much have a two-tier retirement system. Now, that's the same for many nations. The USA has their 401k, 403b, and in fact, there's so many different tax retirement accounts and structures with health savings accounts and whatnot, IRAs, Roth IRAs. The Canadian and the UK governments have similar offerings for their citizens. It's essentially a way where you can tuck money away now and receive a little bit of a tax savings on your salary, as well as a tax savings on the growth of the assets within the retirement accounts. So coming back to my situation, I've actually got a really good superannuation package with my employer. The company puts in above industry award wage superannuation contributions, which is fan-bloody-tastic. I've also been salary sacrificing up to my concessional cap, which is at the moment for me, my accountants advised me it's $15,000, but I was recently speaking to someone who mentioned that number might actually be a little higher at $25,000 per year. So I need to do a little bit of research and get back to you on that. So whilst when I salary sacrifice, instead of paying my marginal tax rate, I actually only pay 15% on the contributions. And for people who aren't familiar with the Australian marginal tax rate, our system, you pay progressively more tax as you increase in income. So it starts off, you have a tax-free threshold. I should know this. It's somewhere around $20,000 or maybe just under that, 18,200. Look, again, Google it. It's somewhere around there, but it's not enough to keep you going. So you start paying tax. It starts off at a fairly low rate and progressively increases. I think the average rate is about 30 to 37 cents in the dollar for most income earners, and then that goes up to about 47% once you're on quite a high income. So it's a progressional tiered or marginal system. So if you're not sure how that works, there's some really awesome explanations on the ATO website. But it means that up to that first $18,000, you're not going to pay tax, and then up to the next bracket, you'll pay the first increment. Then as you go up, you'll continue to pay only the higher tax rate on the amount that you're above the increment. So it's not like you magically start earning above a certain amount of money and you'll suddenly get a huge tax bill. Despite a lot of people at my work that think somehow that it works that way, it's not. It's a really fair system. So straight away I knew, hey, super is going to be a massive tool for me to achieve FIRE, and I'm going to need to use it to my advantage. What does that mean for my FIRE number, for my Y of FIRE? Well, it means that my Get FIRE portfolio, or my taxable investments, only really going to need to keep me going until I reach preservation age, when I can receive my super. So for now, I'll keep stashing as much as the government lets me into super, because hey, why not? And I'll continue to then put any surplus into my taxable investments. And this gives me the peace of mind that my Get FIRE portfolio is only going to have to last me 25 to 30 years. So even though when we did our first pass using the 4% rule, and we worked out, I'm going to need 600,000 up to $1 million, I can actually afford to draw that down a bit quicker. So I, after doing a bit of research and playing with some calculators online, by the way, there's a heap of awesome tools you can use, so statistical tools. You just, get into Google, look at compound depreciation or cost-based calculators. You can actually work out quite easily how long money's going to last you with, projected market returns and your drawdown. So I come up with 7% as a starting point. as a quick draw number. So I talked to some people about this, and they're horrified. 7%? Are you crazy, Captain Fly? Like that is not going to last you. And a lot of them are talking even about using a 3% drawdown, being even more conservative than the traditional 4% rule. And to that, my response is, well, hey, I'm not expecting this money to last forever. Maybe 25 to 30 years, absolute tops. So working backwards with good old spreadsheets, with my projected spending, it means I really only need about 310, 320k of ETFs by myself, and about 500 or 520,000 ETF portfolio once I have a family with that increased spending. So, 30 years though is a pretty long time, and there's no guarantee that the Get Fired portfolio will actually last that whole time. There might even be some legislative changes to how superannuation works. Potentially, they'll raise that preservation age and just put it, that rung just that further out of reach. No one's going to know. 30 years, there's a lot of potential for changing governments to come in, and, we all know they do enjoy tweaking with the superannuation funds. There has been some interesting change of terminology where government, used to refer to super as your super and your fund. And I have noticed that the last couple of governments, it's increasingly being referred to as our superannuation, which is an interesting, from a psychology point of view, it's they're starting to frame super as no longer purely yours. It's now a national tool. But look, I don't want to get into politics. I don't know anything about politics, and I'm sure nobody really wants to hear about it. The why I think it's relevant though, again, the why of FI, is you need to protect yourself or have some kind of insurance against that happening. So for me personally, when I look at my goal of FI, I'm pretty flexible because I know that I can, I enjoy in flying instructing, part-time gigs, and I've got a couple of businesses running in the side, and whilst they're not super profitable, and whilst flying instructing isn't a super profitable gig, it's still an option to earn a little bit of money. So the average amount I was getting instructing is about $100 an hour. So, if you really only need that extra $300 a week, you could achieve that maybe in one day, or maybe split over 2 days at the airport with some sessions there with your students. Hopefully, maybe you're teaching navigation and doing a very long 5-hour flight to maximize your wages for that day. So when I think about it, I know I do have options to go back to part-time work. I know I'm able to tighten the old purse strings and reduce my spending. So I'm really not that worried about some kind of catastrophic market crash or something that's going to try and wipe me out in early retirement. So with my goal set, the next step, I guess, for me was educating myself. Again, that was that step one to reaching financial independence, which we talked about. So I set out to read everything I could. So I read, one of the first books I read was actually Scott Pape's Barefoot Investor, which has actually been around for a very long time. And it's remarkably similar to another book that I read, Dave Ramsey's Total Money Makeover. Now, these are really great books, fantastic books, full of really practical, common sense tips that you can seriously slash your spending, keep that money start investing and get a much better deal. So, he provides you scripts of, I'm talking about Scott Pape here, provides you scripts about, just how am I going to negotiate a better mortgage rate, or just how can I get a better rate on, my internet or my phone service. So, again, great books, definitely recommend as a starting point that you could read something like that. So, I've always been naturally pretty good with money, coming from an engineering background, maths and physics, anything to do with numbers and equations. I get off over that that kind of stuff, which I know some people's eyes will sort of glaze over, but no, I quite like that, and that's why I love with flying. It's very on the numbers game. If you set the correct attitude, the correct power settings, the jet's gonna perform just how you want it to. And it's really fun tweaking and trying to get the best fuel efficiency out of the aircraft and find the best level to be flying at. So similarly with my finances, I was always pretty good at saving, figuring out how I could make money stretch further. So reading those two books, actually, it was almost like a little bit of self-validation, really, and I was glad to see that there was a sort of community of people out there with similar minds. Although I read these books and I thought, look, okay, this is a great solution for most people, for 80 to 90% of people that just want to work a job, pay down their mortgage, get a good deal on their services, go to work, do that 9 to 5 grind, and I guess retire eventually off of a paid off house and super. But it's still, that didn't really sit right with me, because I thought, why would I slave away sort of my whole life making money for someone else, struggling to pay a mortgage in, you look at a market like Sydney where your median house price is, I'm fairly sure, around, it's well over 7 figures now. I look at some of the houses for sale around my area, and some of them are even, multiple millions of dollars for what's essentially just a 4-bedroom house, maybe with 2 bathrooms and 2 garage on like a 400 or 500 square meter block. It just doesn't seem to be good value. So growing up in the country and growing up in regional suburbs, my idea of what property was really took a massive hammering when I came to Sydney for my job as a pilot. I was like, they want how much for a house? And the next step was, and how many years do I need to work to pay that off? So I accept that property is expensive in Sydney and wages are maybe higher in Sydney on average, but the cost to wage ratio is incredible in Sydney. It is over 10, 15x. Whereas you look at somewhere like where I grew up, for example, the multiple is 5 to 6x. So housing affordability varies quite dramatically, I think, across Australia. So yeah, so those strategies presented in the Barefoot Investor and the Dave Ramsey's Money Makeover, they're fantastic books. Those guys are really, really clever, really good authors as well. I really enjoy their writing style. But I knew I needed to take it a step further. And I hadn't quite discovered FIRE yet, or the FIRE community. So I set out to keep reading and keep digesting everything I could. So I found a copy of Robert Kiyosaki's Rich Dad, Poor Dad at my local library. Again, I told you I was a bit savvy before reading these books, so kept my frugal ways. Took the book out of the library, got it for I think it was 2 weeks, and I'd read it overnight. Rich Dad, Poor Dad, Robert Kiyosaki, fantastic book. What I think it really helps with is your mindset. So whilst you're not going to read the book and magically become rich overnight, what it really helped outline for me was the difference between an asset and a liability. And we spoke last episode about that to some great length, and about why you need to gather assets and cut away your liabilities. So that book was great, and that really charged me up. It was my afterburner, my desire for fire, and I knew that I had to have some kind of business. I needed to keep getting assets, and with that abundance mindset, I was going to succeed. So I guess up until this point, I said I'd been good with money, and I'd just been stashing it in term deposits, managed funds, but I'd also been spending pretty much all of it. My job as an engineer and subsequent jobs that I had, I was tutoring whilst I was at university, gardening, anything that I could do for a bit of extra money. I mean, at one point I was picking up cigarette butts from shopping centres and cleaning graffiti because I was actually spending so much money pursuing my dream of becoming a pilot. Almost $300,000, which is it's really high from an aviation's perspective. I think most people would be able to get away with spending probably half of that. Look, the reason why it was so expensive was probably partly my own fault. I did and I hesitated on pulling the trigger at leaving my secure desk job in pursuit of a flying job, which generally pays a lot less and is a lot riskier without the job security, that kind of stuff. So in aviation, if you hesitate or you delay, retraining can actually be quite expensive. So after a while, your skills begin to fade, you sort of get rusty. So you do need to continue to fly and to keep yourself sharp. And of course, if you're not being employed as a pilot, you're going to have to pay for that. Like I said, part of that craftiness with money came out of necessity because I was spending, at one point, it was over $1,000 per hour to train on a particular type of aircraft, and it wasn't cheap. So I'd try and get money anywhere I could. Continuing reading, I found a reference to a book by Benjamin Graham, and I found this through online learning about Warren Buffett, and I found out that he had actually written a foreword to chapters in Benjamin Graham's book, The Intelligent Investor. Now, for someone who's in the FIRE community, obviously those two names are, they're legendaries. They're our Michael Jackson, they're Einstein. They are just two of the most successful investors I think the world has ever seen. And Benjamin Graham was, I believe, was Warren Buffett's mentor, and Buffett learned a lot from Graham. And so I read this book and it's not probably the easiest read. It's quite long, but it's fantastic. It really talks about value investing and how to work out whether something is a good deal, and also working out what kind of investor are you. I think it talks about the difference between an active and a defensive investor, which I'd never really heard of the term defensive investor. I kind of thought there was active and passive investors. So an active investor would tend to work quite hard on his or her investments, whereas a passive investor really just didn't really want much to do with it. So there was some interesting delineations and some new concepts that I learned in that book. So again, fantastic book. I can't remember how many hundreds of pages I got through there, but again, I was hooked. I read Warren Buffett's letters to his shareholders, or his notes, which are freely available on his website through Berkshire Hathaway. It's a pretty rudimentary site, which I guess is probably testament to Buffett's value-based approach when it comes to investing. No frills sort of thing. So I sort of fancied myself a bit of a value investor at that point, and started to look at evaluating individual companies and stocks, and these dividends are really great, and look at the earnings per share and the PE ratios, and And I had a lot of fun over basically a year or two. But the problem was it was taking up quite a lot of time. And I read an article someone forwarded to me about index investing, or what is the index. Of course, everyone is trying to beat the index through active investment, myself included. And anyway, after some 2 years trying to beat the market with my what I believe to be superior investing ability, which let's be honest, it was rubbish. There was nothing special about me other than I liked spreadsheets and numbers. And I found out that I just achieved the index, and when I considered probably all the brokerage and opportunity costs sitting on money, I reckon I would have clearly underperformed the market. So probably would have just been much better off to buy some kind of index tracking fund. So I knew that was what I needed to do. I needed an index fund. So I got to work investigating index funds and learning all I could about index funds. And I discovered, funnily enough, FIRE. So the FIRE Financial Independence Retire Early community is amazing. There are a lot of really talented people providing a lot of fantastic information and guidance online. So one of the first FIRE blogs that I actually discovered was the Aussie Firebug. And the Aussie Firebug is an Australian millennial, as he says, trying to escape the 9-to-5 grind through investing. And he's got some really quality articles on his site, which really led me down the rabbit hole. So I started listening to his podcast, and I noticed that one of his first guests was a Canadian blogger, the Mad Fientist. So I went and I read the Mad Fientist's blogs and listened to his podcasts. And I found someone, one of the first people that he interviewed was Mr. Money Moustache. So sounds like a ridiculous name, but this guy is actually super famous. So we were talking about Warren Buffett and Benjamin Graham as being, kind of the Jesuses, the Beatles of finance. Well, Mr. Money Moustache, he's kind of like one of the celebrities in the FI community. And he's actually hit the mainstream media, so there's loads of articles about him. He's no longer blogging anonymously, and his name's Pete Adeni. I think I've pronounced that correctly. And he lives in Boulder, in Colorado, which is in the United States of America. And Mr. Money Moustache has got hundreds and hundreds of articles. I think there's probably even thousands of articles that he has either written or co-written or featured in. So and they are awesome. Everything from cutting down your bills to investing, dealing with the social aspects of FIRE. Really great stuff. So I pretty much covered to covered the Mad Fientist, Mr. Money Moustache, and the Aussie Firebug. And they really helped me just totally immerse myself in the subject of FI and financial independence. And it really then gave me a better understanding where I could start to come up with a strategy of how to invest. So if you're still with me, it's obviously, the story here about my why of FI. In fact, the majority of it was learning. And as Warren Buffett says, a smart investor is someone who is always listening and reading and learning more. So I got to work with some strategies, and having read all these blogs, I understood there were strategies like lump sum investing, dollar cost averaging, buying the dip, flipping, which is where you buy low, sell high, make money, make money for your brokers, and the buy and hold strategy. So I knew there was all these different ways, different strategies, and I had to somehow kind of figure out which one was the best or which one was most appropriate to me, and maybe mold or pick and mix bits from each to come up with my investing strategy. So, for example, dollar cost averaging or systematic implementation or systematic investing, it provides some kind of benefit against, you put a whole bunch of money in the market and it goes down and then you feel bad. So this psychology or human psychology aspect of investing is kind of what I think makes the market a little bit irrational in the short term. I do believe in an efficient market, and that eventually price and value will be the same thing. But because of people's emotional approach to investing, we see this crazy volatility in the stock market. So dollar cost averaging can be a way that someone with a really low risk appetite might choose to invest their money into the stock market. And it's a really interesting subject. If you want to learn a little bit more, there's a book by Dan Airley called Predictably Irrational, and you can see a lot of it. I think he has some stuff on YouTube as well. Awesome reads, definitely part of your step one. Get into that. And again, another really good book I read was by Michael Kemp called Uncommon Sense, and that kind of talked a little bit about investing in the stock market and why people act the way they do, and why common sense is obviously not that common amongst investors. And Michael Kemp actually, I think, works pretty closely with the Barefoot Investor, so that was how I got onto him as an author. And then he's actually got another really awesome book called Creating Real Wealth. And I think they're all worth a read. You can read them all for free at your local library, or check out something online. There's lots of tools, like I think Audible I haven't used, but I've seen a lot of bloggers and podcasters offering their free trials or limited number of books, and where you can actually get those and read them. So investigate these ways that you can actually do this learning, self-directed learning, for free, and it's not going to cost you. I mean, technically, if you pay taxes, you probably have paid for it, because you've paid the rates that go towards the maintaining the library. So it's your resource, your community resource. So get involved and have a read. And hey, while you're at it, literally just go up and down the same aisle and see if you can pull out a bunch of other great ones. If you find any that you love, please drop a comment, get in touch and let me know, because sometimes I have these really long cruise segments and there's not a lot to do. So if you guys can put me onto a fantastic book, that would be awesome. So other investment strategies, I guess the opposite to the dollar cost averaging, I looked and started learning about lump sum investing, which is kind of like getting all your chips at the casino and sort of sliding them forward and saying all in with a sort of steely eye as you kind of look at the dealer. Well, it sounds scary, but it's actually not. Like I said, I love numbers. So actually, I was like, okay, dollar cost averaging and lump sum, what's better? Like, should I try and balance out the volatility, or should I just go all in? And I read some great papers through Vanguard Research, which is a bunch of finance professionals and statisticians, as well as a few other finance firms like Morningstar, Quantitative. And I actually found out that if you look over time, the market goes up. I mean, we all know that over time the market goes up. That's why the media is always hyping and telling you that, oh, we've reached unprecedented new highs. Look, that's just the way the world's fiscal policy works. With inflation the way it is, the returns on the stock market are always going to be higher and higher and higher. And that is not a bad thing. It's not a good thing. It's literally just our fiscal environment. That's just how it works. So when you consider that the market goes up more than it goes down, you actually get better returns from putting it all in. And I didn't know whether to believe this or not, and I thought, well, let's give it a crack. So I had some money which I had in some managed funds that were, I was actually getting really high, getting charged really high management fees, and they'd tell me, oh, you're getting 12%, you're getting 8%. By the time I actually looked at the amount of money that I put in, how long it was in there, and how much I got out, and annualized the return, it ended up being like 4% or something. And then I had to pay taxes on that. So those little fees really add up. So I took the money out of there, and I was like, well, dollar cost versus lump sum. Okay, bush, let's chuck it in. So I lump sum invested, and I personally believe that is a better approach to investing, because that money that you have just otherwise sitting in, say, a savings account or a term deposit, with today's interest rates, that's barely breaking even. You're actually probably going backwards in terms of purchasing power when you consider the really low rates of return on the savings account. It might be 1 to 3%. When you look at inflation, the target rate of inflation is somewhere between 2 and 3%. You can have a look, for Australians, you can have a look on the Reserve Bank of Australia. You can look at the inflation calculator tool, and you can actually see that, oh, geez, that money is actually eroding in value by more than the interest that I'm actually earning on the bank. And then, of course, you've got to pay income tax on that interest, those bank interest payments. So it's just a joke, especially when you consider, well, what's that money doing? Well, the bank is either fractionally reserve lending against it, or they are just investing it in companies. So, you may as well do the same thing. And so that's what I thought too. So I threw it all in. And, I've had some good and bad timing the market, and it really just taught me that you shouldn't try and time the market. You should have it as being time in the market. So time in the market, not timing the market. Which kind of taught me a little bit when I was buying and selling individual stocks, and I ended up just basically breaking even with the index, or probably getting underperform the index, that I should just buy and hold a index fund strategy like an ETF or an LIC, and just hold it for the long term, and cash flow the dividends, or potentially even sell a small portion as I needed money in retirement. So I got to thinking, okay, lump sum invest is great. What about buying the dip? Could I just take this Benjamin Graham, Warren Buffett style value investing philosophy and apply that to my personal investing strategy? So, and I quickly learned that you can't predict the market. Volatility is a fact of life. Like we read about in Predictably Irrational, people make emotional choices. There are so many different triggers and levers and actions and cogs turning in the stock market and the national economy and the global economy, that prices change, they fluctuate. A company could release an earnings profit schedule which might be a percent lower than what it was forecast the previous quarter, and the stock could plummet 10% or something. And opposite as well. Tesla recently announced an favorable earnings change, and it went up 10%. So you can't predict the market. So what a value investor looks at is what is a good deal, or essentially what can I buy at a discount. So buying the dip is a form of value investing, and it's basically just that. You're buying what's good value at the time. And Warren Buffett has sometimes referred to this as buying a stock that's on the nose with investors, or that's something that's not currently popular. So Mr. Market is selling at a discount. Usually, though, the underlying holdings and companies can be pretty good, and it's for some reason just not the flavor of the month. And that's the key. As long as the underlying business is good, because that's what stock is. You're buying a piece of a profitable, productive company which is taking part in the economy and making people's lives better. So for me, value investing means buying a stock below its net asset value or net tradable assets. And I kind of do this really with listed investment companies, which are actually a form of index fund, very similar to an ETF. But the listed investment company, rather than being automated like an ETF, which an ETFs are often referred to as an open-ended fund, which always by definition trades at its net asset value. A listed investment company is a closed-ended fund, and it can trade at a premium or a discount to its net asset value, or NTA. And a lick, so a good example, that's the first lick I bought was AFIC, which we kind of had a laugh about how silly I was, where I thought AFIC was actually a concrete foundation company. No, it's a listed investment company. So it takes your money and it goes and invests in a bunch of other profitable businesses. But again, depending on the current climate, investors might agree or might disagree with the board's investing decisions, and as a result, the LIC can trade at a premium or a discount. So, a fantastic tool that I discovered again through the Aussie Firebug. I discovered a blogger called Pat the Shuffler, who he had interviewed. Now, Pat's a finance blogger who actually lives in the same city as me, and his website, The Lifelong Shuffle, fantastic website, by the way. Guys should all go and check it out. He has an article which is a LIC discount estimator. So he's actually created a tool, a spreadsheet, which will take the net tradable assets of the company. It will compare that to its actual traded share price and then tell you whether it's actually at a discount or a premium. Of course, value investors would never look at it if it was trading at a premium, so we're only interested in if it's at a discount. So I've used that site and that tool a number of times to work out which LIC is trading at the highest discount, and anytime it's below about 3% is when I get interested in buying. So again, short-term trading versus long-term trading, we kind of talked that it's about time in the market, not timing the market, and the dangers of short trading against being long on a stock. So I personally think that being long on an index stock or being in it for the long haul is the way to go. And maybe that's just, again, my personal investing strategy where I don't really want to put all my time and effort into actively trading. But I also knew that even when I tried it, I didn't have fantastic success, right? So buy and hold for the long term is really what I'm all about. Personally, I think trading short term is a bit of a mugs game. All you're really doing is making your broker richer, complicating your tax returns, and statistically, you're just likely to get taken advantage of by one of the big investment firms, waiting to sort of pounce on any mistake. If you're interested in learning a little bit about that last one, check out a book called Flash Boys by Michael Lewis, and it actually talks about trade latency and how some investment firms literally by, for want of a better word, their position in the internet, or their node in the internet network, they were actually able to trade faster than your general mum and dad investors, and they're actually able to take advantage of that split. So yeah, trading stocks, not interested. Again, we've said a million times, Warren Buffett's famous quote, it's not about timing the market, but about time in the market. And it just, it's proven again by the fact that the majority of millionaires made in the stock market are those who have a really simple buy and hold mentality and who reinvest their dividends. And personally for me, the best way to remove that company risk over the long term is diversifying through a good quality, ultra low fee ETF index fund. So, okay, combining lump sum investing, value investing, dollar cost averaging, and buy and hold, I came up with my personal investing strategy, which it works for me. Personally, I think it's based on mathematical evidence that I've done. It's based on human psychology, which works really well for me because, I'm not very smart, and I'm a little bit impulsive, and I'm also lazy. So it works well for me because my strategy is super simple. Super simple, super easy, and it's really quick. So all I do, I make a regular investment decision every fortnight on which index funds I'm going to purchase and hold, ideally forever. And that's it. It takes literally 5 minutes every fortnight. Whenever I get a windfall, so if that's like an extra payout from work, I sell something, whether I've sold some course or book, or I receive a dividend. I'm just adding that into my brokerage account, and that's just going to add to my fortnightly investment decision. So that way, whenever I get a lump sum, I'm investing it straight away, and I'm going to get higher returns, just like I learned with the Vanguard and Morningstar economic papers, that investing the lump sum straight away is going to give me better returns than dollar cost averaging. So statistically, the sooner I invest my money, the quicker it's working for me. And those dollars are all my employees. So rather than buying a sort of set amount of shares in the chosen index fund or LIC every fortnight, I just allocate a certain amount of money. So for me, I try and give as much money as possible. So I'm aiming for an 80% savings rate. Which I don't achieve every month, but that's my target. And I went to a lot of different schools. I was a bit of a naughty boy, and I got asked to leave quite a few schools. But one thing that did stick with me was my year one primary school teacher at I think my first school. She said to me, "Aim for the moon. Even if you fail, you're still amongst the stars." And, now that I have a master's degree in space engineering, I kind of know that the stars technically are a long way away, a lot further away than the moon. But I still think it's a beautiful saying, and why you should aim really high with your goals. So 80% savings rate, might not get there, but hey, on average, I do. And that gives me so much disposable cash, which, a lot of my colleagues are wasting on flashy cars, expensive meals. Lifestyle inflation in Sydney is horrendous. You can waste a lot of money in this city, and you can waste it trying to impress other people, and by not thinking long term, not being mindful about your spending and your activities. So being mindful, I'm getting that savings rate up to that 80%. And that means I can regularly invest a good amount of money. So at the moment, my goal is to purchase about $3,000 worth of index funds every fortnight. Like I said, the majority of that comes from my job, flying full time. But I fill the gap when I sort of don't meet that savings rate, using income from my passive investments. So the simplest one there is reinvesting the dividends from my portfolio. So I personally choose to have my dividends paid out to me, going into my account, and then I can choose where I want to reinvest them. That helps me, I guess, with the kind of portfolio management, and it gives me a bit of a feeling of control over the situation. But realistically, I probably should just use the DRP. A dividend reinvestment plan, it makes a lot more sense. You save on brokerage, and they usually allow you to buy the stock at a discount to what it's actually trading at. So, yep, probably should be doing that. But again, humans, predictably irrational. I like tinkering. that's pretty much my job, right? Once the plane's in the air, we just sort of slowly tinker, press buttons and things as we fly along. So I like to have them go into my brokerage account, and then I can make my investment decision with that. So other sources of income sometimes come from selling things on eBay, from the websites. I've got a portfolio of websites, property development, which I'm starting to do more of. And also, like, I had this random phase where I started designing loads of stickers and t-shirts, and I put those up on, Redbubble and Teespring and a whole bunch of other sites. And yeah, it was kind of fun for a bit, and I realized I was I sucked at graphic design, which you probably already know if you've seen the website. But nonetheless, it still does occasionally bring in some money, which I just add to the brokerage account. And again, put all these incomings towards the next investment decision. So in terms of the investment decision themselves, at the moment I'm splitting across 9 different index funds, which probably is a little excessive. I basically doubled up every one to try and spread my organizational risk. So, for example, investing in Australian shares through the ETF Vanguard, VAS, and also through the beta shares A200 index fund. So there's some slight differences between those two funds. Beta shares is slightly cheaper, but it's a newer fund. It tracks a slightly different index. I actually have dedicated articles to all of my investment vehicles on the website, which just head to www.captainfi.com and go to the investing tab. And they're all in there for you guys to have a read. So I split across 9 investments, so 5 of which are ultra low fee diversified stock market ETFs, and 4 of which are low cost diversified Australian LICs. So the reason I like the LICs and the reason I invest so heavily in Australia is because of the franking credits. And at the moment, with my salary, the franking credits are a really tax-effective strategy for me to invest. When I reach FIRE, maybe I'll transition to purely ETFs. There is some issues with capital gains tax on the LICs as well. So, it's complicated. It's really hard to work out what the best strategy is, but at the end of the day, you just need to get your skin in the game and start somewhere, because starting is better than procrastinating and doing nothing and just having your money erode via inflation as it sits in the bank. So a lot of my ETFs, or in fact most of the ETFs, are through Vanguard, which are a pretty awesome company. I talk about Vanguard quite a lot on the blog. And essentially, is it Jack or John Bogle, basically who come up with the idea of ETF index funds? Revolutionary. I can't say it off the top of my head, but it's in the trillions now that Vanguard manages. And I'm pretty sure like the Vanguard Australia Fund probably has more money in it than the federal government. So there you go. So splitting ETF-wise, we've got the beta shares A200 Australian Stock Index, the Vanguard Australia Stock Index, the Vanguard Total US Market ETF, and the Vanguard Total World ex-US ETF. And just for extra diversification on the American front, I've also got the BlackRock iShares S&P 500 tracker. So that's pretty much the same thing as the Vanguard Total US Market. In terms of the LICs, the 4 companies that I currently hold are the Australian Foundation Investment Company, AFIC, which are not a concrete company, like I thought it was. The Milton Investment Corporation, Argo Investments, and Brickworks Investments. And these all have a kind of a varying management fee. So the cheapest one is the Vanguard and the BlackRock US index fund. They charge, I think, respectively 0.03 and 0.04%. I have to make sure I haven't got those numbers backwards, but it's incredibly low. It's That's basically $4 for every $10,000 you have invested every year. All right, you'll never find something that cheap. To put in perspective, I think I was paying an active fund manager something like 3%. I didn't know I was paying them. I was getting charged that. And so, what does that make that 100 times cheaper through Vanguard? It's crazy. I was reading that something like 40% of the average person's return on investment is actually gobbled up by fees. So having ultra low fees is super important. You can't control the market, you can't time the market, but what you can control are the fees that you pay. So you might be wondering sort of why the hell I would include Brickworks with its 0.17% MER over Vanguard with Vanguard US with 0.04%, and that's a valid question. And again, people are predictably irrational, and I like investing in LICs as some kind of active thing. Whether it's a waste of time or not, I'm yet to kind of figure out, but so far I've pretty much been just buying the LICs whenever they're at a discount and adding them to my portfolio for the long term. So Pat the Shuffler and your LIC discount estimator, seriously awesome work, mate. You saved me a lot of time going through NTAs and monthly NTA announcements from companies. So, for example, if you're paying a higher expense ratio and you snag a discount at a couple of percent under value, you might actually find that the difference between the management fees and the discount equates to a long-term, a lot of years of management fees. So I've got some figures on the website. I'll link to them in the show notes. But for example, if you manage to pick up Brickworks at 2% under value, and you've nabbed yourself quite a bit of value there, and when you consider the difference in management fees over, say, VTS, the Vanguard American Stock ETF, that equates to something like 15 years worth of management fees. When you look at the maths, it just equals out. So 15 years, that's, and even more if we're talking about Vanguard versus Milton, which the spread is a bit different in management fees, a bit lower, it's 25 years worth. So, yeah, and even, I guess a fairer comparison would probably be between the Aussie companies. So take Milton and BetaShares A200 ETF, for example. A 2% purchase discount on Milton equates to about 40 years worth of free management premiums compared to the ETF. So there's a pretty raging debate on the FI community about what's better, ETFs or LICs, which one should I invest in? But honestly, if you choose to invest in either, you're going to fall pretty close to the mark. My opinion is that actually getting started and investing sooner is going to have a much greater influence on your financial well-being than figuring out what the difference between those two investment classes are. So I guess in a nutshell, and we kind of touched on it earlier, I'm probably grossly oversimplifying things here. So if any actual professionals listening out, feel free to pull me up and actually tell me what it really is. But my understanding is ETFs are fairly straightforward, open-ended trust structures, and they must pay out all the dividends directly to shareholders of the portfolio that they own within their financial year, or they sort of get some pretty hefty tax penalties. As opposed to a LIC, which is a closed-ended corporate or company structure which can retain their earnings for future distribution. So say business is booming and a lot of companies are throwing off real good dividends because the companies can't think of any ways to reinvest them in the company R&D. Now the ETF structure has to distribute those to the holders, to the unit holders of the ETF. whereas the LIC can potentially retain that and trickle feed it out to investors or the shareholders of that LIC over a period of time. You can think about this in a few ways. I guess it could be tax effective if you want a more reliable income / annuity. Then the LIC could potentially hold that cash to provide you a stable dividend for other times when, say, the market's not doing so good. Whereas the ETF, sort of giving it to all you in one big hit, that might increase your tax payable for that year. Some people, though, they don't really like that sort of babysitting type approach, and they'd rather just sort of have their money given to them straight up, pay the tax, and then get those dollar employees working for them straight away. The other difference, I guess, is that ETFs automatically rebalance depending on the index they're tracking. So in Australia, due to the market cap, that's fairly heavy on financials, like the banks. Everyone knows that the big four are pretty big in Australian economy, and mining stocks as well. Whereas LICs, on the other hand, employ a fund manager to pick stocks. So LICs are actually like an investment, like an active investment, but whilst I'm against stock picking in general, it's more that you sort of have to pay a premium for someone to do it in most actively managed funds, which I think is ironic because most actively managed funds underperform the index. So, it's kind of funny, you're basically paying someone extra to stuff up your investments for you when it's actually just much cheaper and better to have an ETF. So it sounds like I'm bashing LICs here, but I'm not. I do buy LICs as well, especially these older, more conservative LICs, which have sort of low, ultra low. I wouldn't call them ultra low fees. I'd say the ETF is ultra low fee. I'd say the LIC is probably low fee. And a lot of these older low fee LICs have a pretty good track record, and their portfolios mostly mimic the index. And they sort of reserve the right to deviate away from some of the larger speculative stocks. And the ones I invest in, say Milton Afic, Brickworks, they tend to focus on more high dividend yielding sectors or owning stocks that have an increasing dividend. So it's not just the fact that you can buy a LIC below its value that I like. So the LICs that I own have strong histories of producing increasing dividend yields to shareholders. And ultimately, when you're building a get-fired portfolio or a fire portfolio, you're looking to replace the income you earn as an employee, and you essentially do that with a dividend stream. That's, you can sell portions of stocks, but the dividend stream is one of the simplest. And we'll talk a little bit more about dividend investing when we compare the Thornhill, the Peter Thornhill approach and the Boglehead type capital growth investing scenarios. But in the crux, the Thornhill or dividend investing approach is very tax efficient in Australia due to franking credit refunds. So whilst I'm investing in global ETFs, I'm also keeping some Australian LICs just for that increased tax effectiveness. So, and I'll start to wrap it up here. Some of the benefits, I think, to my investment strategy are emotion. So in terms of emotion, I'm technically dollar cost averaging into the market with my fortnightly investment decisions, which ironically is also a lump sum investment because I'm investing the money as soon as I get it. By doing that, I'm removing any of the emotion regarding how's the market performed, has it gone up, has it gone down, and I don't have to stress about that. It's really simple. I just stick to my same strategy of investing every fortnight, and I don't have to really think about it. The second benefit is cost base. So whilst I'm lump sum investing every fortnight, in the long term, this means I actually buy shares cheaper. And how this works is if the market rises and the price of shares increase, my $3,000 fortnightly investment decision buys me less shares that fortnight. On the flip side, if the market drops and the valuations go down, then my $3,000 buys me more. So overall, when I consider the total amount of shares that I own, I've actually bought more at a lower price than I have bought less at a higher price. So I'm getting better value for money overall. Third benefit is diversification. So by splitting my purchases across 9 different ETFs and LICs over the whole world, I rest easy knowing that I've got a huge diversification at a rock bottom price. So for me to lose my money, I would need thousands of globally recognized companies and brands to collapse virtually overnight. I mean, it could happen, but I believe it's statistically insignificant. I dare say I'd probably be more worried about fighting off the zombie apocalypse or finding my place in a new world order than I would about my share portfolio going down. So yeah, diversification is really important. The fourth benefit, franking credits. So having, I guess, the majority of my money invested in the Australian market might seem like a classic case of home bias, but the franking credits are just, they're too good to pass up. When you consider them, they're almost the whole percentage point extra on your return. So for someone chasing FIRE, where dividend yield and tax efficiency are two major factors in quickly growing a portfolio you can live off, it's a huge impact. It's too good to pass up. And I've actually written about this specifically in the case about Aussie shares and franking credits. And there's some fantastic other articles on the web. Pat the Shuffler from the Lifelong Shuffle also has a fantastic article on franking credits, which you guys should all read. Benefit number 5, I never need to know when to sell. So with the buy and hold strategy, I just buy and hold. I never need to know. So my smartly diversified holdings of thousands of different companies are all getting reevaluated and rebalanced, and the ETF sorts them all out for me. I never ever need to worry about getting the best price for a sale or working out what my CGT implications are. I just sit back by the pool, sip cocktails from a coconut while the dividends continue to pour in and increase over time. Well, okay, maybe not the coconut thing, but you get the sentiment. It cuts out a huge amount of money that would be wasted on brokerage by stock picking or having to sell my holdings. Benefit 6 is value. So by purchasing the LIC at a discount, I know it's instantly a good deal for me, and generally it's going to go up in value with volatility and over time. So I'm confident that if I do need to sell that stock in the future, A, I'm going to be able to get more than what I paid for it, and B, again, I don't plan to sell it, and I only buy it because I'm buying it for the increasing dividend stream. So value is really important. So another benefit is management fees. So by buying an ultra low fee ETF or a low fee index funds, you're going to pay bugger all in portfolio management fees. So we spoke about a portfolio of $1 million earlier. And if on average across the 9 different ETFs you pay a management expense ratio of 0.1%, that'd only be $1,000 a year in management fees, which is incredible. You'd spend more every year if you went out for dinner once a month. So management fees and value, super important. I guess one of the last benefits is free portfolio tracking. It's probably no coincidence that I have less than 10 holdings in my portfolio, which means that I don't have to pay for my ShareSite account. So I did start tracking my portfolio originally, and I'm pretty embarrassed to say, using Microsoft Excel, which I had a good red hot crack at it. I had a fairly complicated spreadsheet, which I just could not manage in the end. I tried using the registries as well to manage the portfolio, but they a lot of the registries like Computershare and Link, they want to charge you for your end of financial year tax documents. Anyway, I stumbled across ShareSite on I think it was the Aussie Firebugs blog, where he had a podcast interviewing someone from the company, and I thought, well, I'll give it a crack, and it's been super easy to use. dividends, I guess, roll in through the year, and I log into my ShareSite account probably once a year at tax time. I just go through my transaction statement through my brokerage account, and I cross-check. I make sure all of the dividends are accounted for in ShareSite. Then I just print the tax summary and hand it to my accountant, and sort of usually sit smugly whilst they read the script and transfer it into their system, and then they try and charge me for several hours worth of work, and I say, well, hang on, I've done it all for you. I've given you the summaries. But anyway, look, not sponsored by ShareSite or anything, but hey, ShareSite, if you're listening, feel free to send me $1 million. I'll take it in Vanguard shares, thanks, ETFs. Just kidding. Anyway, look, so that's my personal investing strategy, and a little bit about how I got started. I hope you got something out of it, and you might even be able to tweak it or implement something like it yourself. If you have a different way of looking at things, or there's something you think I might have missed out, hey, get in touch and let me know. My ears are open. I'm really interested to see what people think. Again, remember, I'm not a financial professional. This is just a bloke trying to invest in index funds to reach financial independence. Thanks for listening to another episode of the Captain Fi Financial Independence podcast. To read the transcript or check out the show notes, head over to www.captainfi.com for all the details. If you have a question for the captain, make sure to get in touch. You might even make it on the airwaves. You can reach me online through the Captain Fi contact form, or get in touch through the socials. I'm active on Facebook and Instagram, as well as a number of online finance and investing forums. And finally, remember, the information presented on the show and the links provided are for general information purposes only. They should not be taken as constituting professional financial advice. You should always do your own research when making any financial decisions, and make sure it's appropriate for your personal circumstance.